Well, firstly, I think that the decision by the Reserve Bank was the incorrect decision. And fundamentally, it seems like it was down to the Reserve Bank not putting as much focus or attention as we thought that they might have on the monthly inflation indicator. I think that there is still some concern from the board that inflation potentially may rebound and that it's not on a sustainable path to be within their 2 to 3% target. So this is basically telling us that they don't really trust the monthly inflation indicator, that they want to wait for more time. They basically want to wait for the full set of the quarterly inflation figures, which come out later this month. And that's a signal to economists that they're willing to move a bit slower and in line with those quarterly inflation prints.
How surprised were you when the decision dropped?
Extremely surprised. I think that the run of data that we've had in the past month has signalled the need for lower interest rates and that rate relief from the monthly inflation figures that we had, from the very poor retail data, from the lack of a rebound in consumer confidence, despite the fact that we have had lower inflation, a few rate cuts, tax cuts as well. And the GDP figures a few months ago were also quite poor and lower than the Reserve Bank's own forecast. So I guess I'm just struggling to understand how the Reserve Bank can move from talking about potentially cutting the cash rate by 50 basis points at its last meeting in May, and then at this meeting to saying no change to rates, despite the run of data being unanimously weak.
Financial markets had a 96% bet on the prospect of a cut. It's long been thought the RBA wouldn't defy market expectations. Is this also a message to markets?
I mean, markets do run hot and cold, and that happens everywhere. It doesn't just happen in Australia. So the central banks have to sort of guide the markets to the pricing that they probably think is a bit more accurate. I mean, there have been periods of time before when the Reserve Bank hasn't moved in line with market expectations. It is pretty rare though. So perhaps the Reserve Bank is really trying to tell markets that they're going to take it slow and steady. Although when you look at financial market pricing, I wouldn't really say that, it's become too dovish in expecting that the Reserve Bank is going to be aggressively slashing the cash rate from here. It's got the cash rate ending somewhere at just below 3% in 12 months' time. I wouldn't really say that that's an aggressive rate hiking cycle, but I suppose maybe the central bank here is trying to guide us to more of a steady decline to interest rates than where a lot of financial market participants think it will be.
You say the RBA has made a mistake today. What are the consequences of holding monetary policy at restrictive settings for too long?
Well, I basically see two major risks with the Reserve Bank holding interest rates at a high level. The first one is that there is the risk of an undershoot on the inflation target, which basically means that inflation comes in below the Reserve Bank's target band. Of course, it doesn't feel like we're going to get to that situation because we've had 2 years worth of pretty high inflation figures. But the longer that you keep the economy running at a subpar pace, the higher the probability is that you do get inflation not meeting the 2 to 3% target band. And the monthly inflation figure at the moment says that the trimmed mean, the annual trim mean, is running at around 2.5%, so smack bang in the middle of the band. We've got anemic GDP growth running at about 1.5% per annum. So the longer that the economy stays at this subpar pace, the higher the risk that we get inflation running lower than the RBA wants. And the second risk is, of course, what happens to the labour market. So basically, the Reserve Bank has started cutting interest rates in February and May to prevent the unemployment rate from rising too much further, and also because the inflation environment allowed them to. So if we keep the economy in this restrictive environment through higher rates, then instead of the unemployment rate potentially reaching 4.4, maybe 4.5% as per the Reserve Bank's estimates, it could potentially get even higher than that. And that's a worst case outcome for the economy because it means that more people are going to be unemployed.
For the first time, we've been told how many board members voted in favour and against the decision, with 6 in favour of a hold and 3 against. What is this information going to mean in future to markets and economists as they revise their forecasts?
Unfortunately, I don't think we're going to get published numbers or detail about who the members are of the board who are pro or for or against the decision. It would be interesting to see how the RBA members, and there's 3 members from the RBA on the board, how they voted. I assume that in this decision, the RBA's statement from the staff itself was that a no change decision was the best one, given the RBA's forecast. But it would be more interesting to see how the breakdown of those votes is going to be. But I guess it also gives us a flavour as to how the board is thinking about the decision, and the fact that there were 3 members of the board who thought, I assume that they thought that the rates should have been cut. There is still some chance that we are going to get, obviously, a rate cut at the next meeting, and that is our view as well, that instead of cutting rates at this meeting, there's going to be a rate cut at the next meeting following the quarterly inflation figures. But to be honest, without the information about who is actually making those votes, I don't really know if it gives us too much information beyond what we already have.
Okay, well, AMP had been forecasting cuts today in August, November and February next year. You've just said you do expect one in August. What more can you tell us about the likely path of interest rates now?
I think it will just take longer to get to what our expected endpoint is for the cash rate, which is 2.85%. So basically another 4 sets of 0.25% rate cuts from here. That would basically take us to more or less a neutral level of interest rates for Australia, where you're not putting too much upwards or downwards pressure on the economy. And I think that that's mostly where global central banks are going to take interest rates. So I think Australia is going to be around the middle of the pack if we compare ourselves to the whole world. So we don't expect rates to get back to their pre-COVID lows. At the same time, they're not going to be particularly high. So there is more good news ahead for mortgage holders, and I think for economic growth overall, because we do need lower interest rates really to get the economy moving again.
Mousina, thank you.
Thanks, Kirsten.